Hello, everyone. I'm Andrew Schmertz. The jobs numbers crushed it. The U.S. Labor Department reports that 211,000 jobs were created in November and that wages rose as well. The unemployment rate remained at 5%. There is a downside. The labor participation level remained at 30-year lows. The numbers are likely to give all the ammunition the Fed will need to raise interest rates either later this month or very early next year. Wall Street cheered the numbers, as it may provide some certainty as to what the Fed will do. Let's take a look at the final numbers. The Dow Jones Industrial Average up 370 points to 17,847. The NASDAQ up 104 3/4 to 5142. The S&P 500 up 4207. That's better than 2% across the board. Not a bad day on the street. Are we finally seeing the jobs recovery we've been promised, but has in fact been so slow? With this and more on what is next for the economy and interest rates and the markets, we're joined by Mike Lear, Vice President of Portfolio Management at Athena Capital Advisors. Welcome back to Rise Exchange, Mike.
Great to see you.
Okay, so the headline number here, 217,000 jobs, looking pretty good. Your overall just general picture of the report today?
Almost as important as the number that was released today was the fact that they went and revised the previous two numbers upwards. So if you look, what we have is a consistent pattern of over 200,000 jobs, which is given the Fed every signal they would want to have to be able to raise rates.
The jobs report is sort of like oatmeal. You can put a lot into it, and some of it is not necessarily very digestible. Mainly that the labor participation numbers continue to be very weak, but the weekly numbers showed that more people are sort of starting to come back into the workforce. Is that what you're sensing?
Yeah, and the labor force participation number has been a weak spot for a while. We've known that it's been at decade lows for a very long time. So what some of the other weaknesses within the number were in, you see retail moving from bricks and mortar to the continued change from bricks and mortar to online, and then some weakness in the mining and logging sectors.
And energy, I imagine.
Yeah, energy across the board.
Got to be energy across the board right now.
So they're releasing jobs. So that all of it made a lot of sense.
So where's the strength coming from right now?
The strength is coming from, we have some direction. Like before, the pattern was good news was bad news, and now good news is good news. And so I think what we have now is some grounding. So we know the Fed's going to raise finally. It's been too long. And so now we can pick a direction.
Because Janet Yellen has said this is going to be a data-driven decision. She may have the data in hand. Is that why we saw the markets rally so much today? And you have to think whether it was sort of maybe overbought a little bit, a little manic.
Yeah, a little overbought on the day, but I think if you look at the year and the sum total of the year, it's still been a flat market or flattish market. So I think it's good that we could have a good December.
If you're a retail investor, what is your strategy right now in the market, do you think?
The retail investors shouldn't be so focused on the rate rise as it relates to equities. So I think what you'll see is the continued pattern of rising earnings that are going to lead equity prices higher forward. Where you would be concerned as a retail investor is in those really interest rate sensitive assets. So if you're looking at utilities, MLPs, some of the energy sectors, some of the really dollar dependent sectors, those might continue to be weak.
If we start raising interest rates, at what point do bonds become compelling competition to equities? The reason we see the bond market where it is and the equity markets where it is if you're looking for interest-bearing bonds and saving money, you're not getting it from bonds right now. But what point does that change?
That's a long way off. So just to put it in some sort of context, we're at on the 10-year Treasury, we're at about a 2.2% yield. Most of the projections we're looking at see that not changing significantly. You're looking at like 3.5, 2 or 3 years out. So it's going to be a moderated rise going forward. So I don't think there's any prospects for the high bond yields that we're seeing in the 90s.
We're going into the holiday season, so let's talk about risks to the markets right now. What are some of them that could sort of bite people if they're not expecting it?
If they're not expecting it, further terrorist action. Sad that we have to bring that up, but that could weigh on markets if there's anything substantial. It's
interesting that the markets really rallied today despite news that this was likely a terrorist attack in California. So it seems that at the moment, these sort of terrorist attacks, for the markets at least, are one-day events.
Yeah, I mean, it's really sad, but it's become de rigueur for the markets. I mean, we've seen these actions, as sad as they are, happen, and I think people have been conditioned to accept them and really put them into context versus their investments.
As the jobs market comes back and as we start to see some helping of the economy along the way, what sector of the markets benefit the most? Is it the big cap guys out there, or are we going to start seeing some recovery in the small caps, which have had a difficult year?
Small caps should recover, but I think that's going to be a longer story. As we get in the later innings of this recovery, that's taken forever.
And why is that? Is that simply because the risk there is too great?
No, it's just been it's first time. I mean, literally, we had a first time fall in global markets, and we had all the Fed actions from around the world. All those together, taken together, have created a really risk-averse base.
Okay, so now in the United States, we're probably going to have a rising interest rate environment. Yet in Europe, we're getting a drop in interest rates to negative interest rates, a potential deflationary environment. Our house is getting a little bit better. Come back to this analogy. We're starting to throw some paint on the house and put up some holiday decorations. And yet the rest of the neighborhood is close to burning down, it seems.
There's still some attractive buys in Europe, but just to touch on the differences, we're at 5% unemployment. Eurozone's about 10% if you take all the periphery.
Why are we not, catching that contagion?
I just think if you look at the U.S., we have one economic policy. We have the Fed. They're a collection of nations that don't necessarily have the ability to affect currencies and affect.
Well, and so this may be an indictment on the euro at the end of the day.
It could be an indictment on the euro, but it also lends itself to pockets of strength within the eurozone.
Okay, Mike Lear, thank you so much. Have a good weekend. See you soon.
Thanks.